Our long-term goals do not change, but we have to reevaluate where we are today.
With us in the studio today for the Rocketship Experience is Ramesh Schaffter. Ramesh heads the Janashakthi group, which is a new formation bringing together, Ramesh, several businesses that have been with the Schaffter family for several years, if not several decades, many of them several decades, I think. Okay, when we start, can you tell us about why a conglomerate structure? Why did you bring the three businesses that are already now in the conglomerate structure in when they are already listed companies?
Thank you, Shamendra. So, Janashakthi, as you said, several decades old. Some of the business units are even older. And all of them have existed without a group structure being publicized. The group structure has always existed.
Right.
And for the last 5 years or so, we have had these business units. But each one acted on its own, and then thanks to COVID actually, we started looking at how we can leverage the strengths of the group, how we can share strengths. We had shared services, which is something we introduced, and it's been very successful over the last 2 years, and I'll talk about that in more detail. We also found that the Janashakthi brand is very well known, but identified predominantly with insurance.
Insurance, yeah.
But some of the other businesses get the benefit of that association, the trust and confidence that people have in the stability of the insurance company, and now being a Janashakthi group company for the other business units counts for very much.
Right.
And so the time was right. It was an evolution, and the time is right now to launch a brand of its own for the parent. And hence, during this year and in the last couple of months, we have been creating an identity for the parent separate from the well-known insurance company.
Sure.
And that has been a very exciting time for us.
Okay. So let's step back, Ramesh. You suggested that unofficially, probably in the background, this structure has more or less existed, right? Sri Lanka is at a challenging moment in its economic history for sure, and history altogether potentially. And for businesses, this is challenging in several ways. The cost of capital is much higher. Liquidity is a challenge. It's difficult to budget and hedge risks in a climate when prices are fluctuating. What value, if at all, in this climate does the structure that you've now formally put in place bring?
One, the formal structure is looking at a 10-year horizon and not at the 6-month situation.
Sure.
So, as I've told members of our team, our long-term goals do not change, but we have to reevaluate where we are today and what exactly we're doing today. What we set out to do a year ago, we cannot do today. You mentioned cost of capital, huge issue, and especially for a business like ours, because the parent company does not engage in business. We are in the business of buying assets, buying companies, developing those assets, perhaps selling some of those assets or selling down on those assets. So we're in the business of buying businesses. And that's what we've done right through our history. If you actually take a deeper look at our group, we've been involved in many acquisitions of listed companies, unlisted companies. We have, for example, in the NBFI sector, Orient Finance, which was an acquisition. And then Orient Finance and the group went and acquired Barclays Finance and amalgamated it. Within the Janashakthi insurance framework, we acquired National Insurance Corporation, we acquired the general business of AIA, and then we actually exited the general business. So it is a management of portfolio.
Right.
And that portfolio is primarily business units, some land assets, and in fact some stock market portfolio investments as well. That is also a key part of our business.
Sure.
Not doing great right now in the last 6 months with the stock market being down. So what's the purpose? With COVID, we looked at how can we minimize cost or reduce cost without retrenching people. And we had the consent of the business units to start sharing people, and that shared services has come on track and is working very well. we leverage on strengths in one company to assist the other company, and that could be in terms of human resources, and that's another challenge we face now because so many people are either leaving the country or they're going into companies which offer them dollar denominated, especially in the field of IT, there's dollar denominated salaries. So that turmoil is causing a lot of disruption in terms of the human resources, and that's a challenge perhaps the whole country is facing. Cost of capital, you mentioned, is an issue, but the portfolio of businesses are such that two of our businesses are actually benefiting from the high cost of capital or the high interest rates.
Explain that quickly to business.
So, as an insurance company, we're now in life insurance, and life insurance manages funds of policyholders, and a share of that comes to the parent or the shareholder. Sure. And in some cases, you've guaranteed rates to policyholders over a period of time, and those rates are substantially lower than what we're looking at today.
Lower than the market rates.
Much lower than the market rates. And so when you have treasury bills at 33%, there's a much larger component of that goes to the company itself.
Sure.
Then there's the shareholders' funds, which are also just invested and now earning 3 times what it was a year ago. Money for jam, as they would say. Then you have the treasuries business of First Capital. People are moving money out of banks, moving money out of unit trusts and all these other sources and putting it into government bills, because who else is giving you 30 plus? Yesterday, I think it was 33 or something.
Yes.
So, very good environment for First Capital treasuries. The stock market has been active, so First Capital Equities is having a good run. But on the other side, no one's raising debt, so capital market activity is low. Nobody's having debenture issues. That's almost nil. So you have to balance the portfolio. At all times, the parent company's role is to balance the portfolio, see which ones have a longer term future, which ones do we actually invest more into, and which ones do we go slow on. Because not every business is in the same cycle of maturity.
So you are highlighting two aspects of the structure that are potentially benefit, the way I see it, right? There is the cost benefit of shared services, of bringing together units that can potentially serve the whole group. On the other side, there is the portfolio approach, which you always have had, right? Tell us what does the portfolio approach to managing the group potentially add to shareholder value creation? Why aren't these units unable to do that potentially? You must be having some idea about what the portfolio approach brings to the table.
So for me, the opposite of portfolio approach is a sentimental approach.
Right.
And I'm already married, and I'm therefore not married to any of these investments.
Sure.
So with any investment, you have a gestation period, you have startups, then you have second round funding, you have a growth phase. And I love the BCG matrix because I really feel that works. And in the BCG matrix, you get to that cash cow situation is the ideal, where you have high market share, low growth industry, barriers to entry, etc., etc. What we try to avoid is the stars in that matrix where you're constantly having to put more money in and more money in and you're chasing your tail. That happens a lot in tech.
Right.
You're constantly trying to update technology. You're constantly trying to keep pace with the world around you. So you're making money on the one hand, but you're having to invest twice as much. The idea of the portfolio analysis is you see, okay, what's going to work for the next 10 years? And what's going to actually be a drag on the group. And this is linked to being a conglomerate, because a conglomerate would invest in some businesses knowing it's not going to make money in the first 3 years, but that it has a long-term future. And what we've tried, and I mentioned the BCG matrix because what we've tried is to go for critical mass. And that is why we amalgamated with Bartlett's, and just prior to this crisis, we were looking at opportunities in the NBFI space because we want to be ideally in the top 10, maybe top 5 players in that sector. It doesn't make sense being the 25th player out of 50. There's no joy in that because economies are just not there. Then same with the other areas, we look at pushing organic growth if we can. Or we look at inorganic growth where we just go out and acquire, use the positives that you have to build the businesses. On the subject of shared services, it's not just synergies of cost saving and number, headcount, etc. The smaller businesses are able to get the resources in terms of head of legal or head of marketing, which they could never afford by themselves. So it's a quality of service. And phase one is where we are working on a cost reimbursement, and phase two would be where we actually run that as a separate business. And the whole idea is that we're offering the smaller businesses a much better quality of high level input. So our group head of IT, for example, was head of IT for a bank. He comes with the resources and knowledge and connections that a small business like even Orient in the overall context is a small business would never be able to afford. But they can afford 25% of his time. And that's where it's working for us.
I'm sure in this portfolio approach and any approach that any conglomerate takes at this point, they would want to avoid scale for scale's sake. How do you approach scale and growth in the current economic climate? How do you strategize around that?
With difficulty. So, as I said, the strategies are 10-year strategies, and yes, we had to review what we were doing. April, when we had all of the disturbances and the planned default, structured default being announced, our board decided freeze all acquisitions. We were having 4 acquisitions in the pipeline at that time. Right. We have a specialist M&A division, and they're obviously working for their bread. So there we froze all acquisitions. Why? Because we said we don't have adequate sight. And in one particular large acquisition, we said, let's meet again in December and review where the country is. And with the whole perspective of risk, we have to have some clarity before we forge ahead. And going back to BCG matrix, it's not market share for the sake of saying, oh, we're number 1, number 2, number 3. It's not hubris. It is where, especially in the service industries, we've seen it with insurance, we've seen it with finance, a large component of your expenditure is management cost, which is more or less fixed. The moment you scale up, the moment you have greater volumes, your management cost does not grow. We've seen it with general insurance, where you could just add on more turnover and have no increase in management costs. Because you're not renting more space, your capacity, and really at the moment, and I fully endorse what the CBSL has been trying to do, although perhaps not always agreed with their methods. Their consolidation in the NBFI sector is a must-do. It's a no-brainer, because it's a typical case of 1 and 1 not making 2, but making about 4 or 5, because you all are all losing money in that high management expense, high advertising costs, staffing, personnel are scarce, but even if you had the personnel, that costs you a lot of money. So it is growth not for hubris sake, but for purposes of greater efficiency and much greater profitability.
What are the conditions that you or the board will be comfortable with seeing to come back to that model of M&A-led growth potentially that you set out on a path for, but have put on hold?
So key thing, Shamindra, is that the cost of capital.
Sure.
And what we try to do, and to some extent we do, is that when the rates are low, you try to lock in as long as you can with those rates, fixed rates and whatever. So we carry a portfolio of funding mechanisms. And that would be commercial papers, which are short-term, variable rate. Then you have the bank loans, which could go up to about 5 years, maybe 7 years if you're lucky. And those can be fixed rates. And then you have debentures, which you could or could not issue, either listed or unlisted. And having that mix keeps the weighted average cost of capital down. Having said that, in today's market, liquidity is a huge issue. Interbank negative liquidity is in the minus 500 billion range. And therefore, everything's got tight. It's not just central bank rates that have moved up. AWPLR has moved up, and therefore our cost of capital has also moved up. So every investment appraisal, your discount factor that you now use is not your 15% benchmark. And so no benchmark will work right now. So we have to review what we're doing, and that's why we've frozen all acquisitions.
What are those benchmarks that you think are critical to have in place, and we are likely to have in place should Sri Lanka strike a deal with its foreign creditors?
So one would hope, and I know the worm has turned with inflation, and one would hope that if that continues, and many of our forecasts, even First Capital researchers, were forecasting single digit, maybe low double digit inflation, and therefore interest rates would also come down. So we see this as a temporary setback. When I say temporary, could be a year.
Sure.
But we would see rates easing off in some way. If there is funding coming through the IMF, immediately the IMF reaches agreement, bilateral lenders and donors would also come on board. Many are waiting for the IMF. Many are waiting for a firm decision on the debt restructuring. And they would therefore know when the IMF endorses it that there is some fiscal discipline coming in and they're heading in the right direction. That would improve all the multiple things of exchange rate, and even exchange rate we expect an improvement. Where will that leave us? At these costs of capital, we have to just take a wait and see. Some opportunities will go past us. But my policy is you miss one bus, there's always another bus. And sometimes in investing, you need to be patient. You need to wait for your right opportunity. It's not just, we might miss this and so we run after everything that's going. There's lots of opportunities right now. We saw COVID as an opportunity, and that's how we went into looking at M&A in a more aggressive fashion. But today's problem is not like the COVID problem. There are structural
Contrast
issues.
that. Why is today's problem different?
So COVID was a lack of mobility, possibly health issues, work from home, but many companies, and in fact our company has adapted to work from home very well.
Right.
It's also changed the mindset of people, where even now some of our units work on hybrid models. People come in 3 days a week and work from home 2 days a week. It works well for some people, does not work well for some. Some have the environment where they actually have greater output at home. Some need to get out of the house.
Sure.
And that's fine. And I think we're evaluating what works for some, what does not work for some. And if you're working from home, you could be working from home in Nugegoda, you could be working from home in Pasikuda. It doesn't matter. The downside is the world has discovered that, and so we're losing people to foreign companies which are getting much cheaper labor, but paying them $1,000, and that sounds very good. And that's the challenge. But those are all temporary setbacks because, again, demand supply.
So if you contrast those challenges to the current set of economic challenges from a portfolio point of view, just contrast to us what those mean.
With COVID, there was a loosening of monetary policy. Statutory reserve ratios or SRR was reduced. The government purposefully ease these things so that the availability of credit would improve, and all of those things. Cost of borrowing came down, bond rates came down to 4%, 5%, or bill rates came down to 4.5%, 5%. AWPLR was perhaps 6.5%, and you were having people putting a floor just so that you didn't pay less interest than they would like to have. And it was very easy to access funding at that time. And some companies successfully did that. That also spurred the stock market. Though there was COVID happening, the stock market had its best year. And many companies went to the market for money and successfully raised money. So our parent companies actually took a rather than an opportunistic approach, we took an approach where we look at a listing in the next couple of years. We did intend to have a private placement in April, which was not the best timing. And therefore, some of our equity funding, which we expected, is not happening. If we had that equity funding, we could spend it on an acquisition, even if the numbers made sense, without having to stretch on our gearing and such things. But we went on worst case 20%. We're looking at now worst case probably 30%. I think the biggest issue for Sri Lanka post-COVID and the tightening, they started tightening credit. They increased the SRR back again. That contracted the credit in the market. And really the toughest thing was availability of finance, cost of finance, and then the uncertainty with all of this. We don't know what the haircut will be. We don't know whether Sri Lanka will actually go back to the brink of collapse. We were very close to the brink of economic collapse. People say hyperinflation, but 70% is not hyperinflation. It crosses 100 and then it's like a spiral. It just keeps going and you'll be revising prices daily. We've managed to pull back. Whether we can actually turn around. So you asked me the question, what would be that environment that we want? So first is we want to be stable in terms of being strong enough to take advantage of such opportunities, because opportunities will come. But I don't believe now is the time to try to test the water. The numbers don't make sense right now, but if you're strong enough to catch a bus next year, year after, that is the journey we want to be on. And so that's what we're trying to do.
When the markets do open up, when you have more competitive pricing for capital, where do you think that will come from? From the banking system, from private markets, or the public market?
Combination, because right now people have pulled money out of money market funds which were in the billions, and they have lost, probably collectively, they have lost about 80 to 90% of their money market funds under management. By money market funds, I mean unit trusts managing money that could be withdrawn overnight. Yeah. There's also a lag effect, because when the government, and really the issue was the way in which the economy was managed, we saw shocks. So we saw in 1 week a 7% increase in rates, and then again it shot up like that, rather than a gradual increase. And that's really what the economy cannot take. So you had then anomalies created. So you have money market funds giving a very healthy 12%, and suddenly the government bonds were giving maybe 25%, and everyone pulled their money out and went there. Bank liquidity is challenged because they did the same to banks. But today the banks are giving something not far off. And so you're reaching some level of stability as far as that is concerned. And in fact, now even the money market funds, which have a mix of investments, so there's a lag effect to catch up, and they're catching up. They're now at 25, 26%, which isn't far off, for the flexibility of being able to take it out in a day, so that money is coming back. So what will happen for me, ideally, is that banks will play the role they used to play a year ago. Money market funds and other short-term lenders will play the role that they used to play a year ago. Other investors, whether they will go in for the long-term debentures and whether there'll be that appetite now that those tax benefits have gone. Now there's a withholding tax coming back, and it's not a final tax. It could be a declared on your income tax. I'm not so sure that that's as attractive as some of these other mechanisms.
Right.
I'm not so sure. But everything has an investor.
So Ramesh, your background as a portfolio manager is coming through in your conversation. You have that innate ability to quickly surmise about how capital is likely to play out. You're also chief executive. This role far more challenging than being a portfolio manager or simply allocating resources. What do you think those big challenges are in front that you as chief executive need to address at the new Janashakthi group in its current formation? Is culture, is unity, is a unified vision. How are those important? How are you doing on those things?
I don't know how I'm doing, but what are the challenges? So one of the challenges was COVID meant less face-to-face interaction. And it's always nice to have face-to-face interaction. Even if it's on a hybrid model, you come in a couple of days a week, you meet face-to-face. There's stuff you can get done faster, sometimes face-to-face. So the group planned and executed an unveiling of its new logo, JXG. And people ask me, what's the X for? I say, that's because we're sexy. But the reality is, formerly Janashakthi General was identified as JG, and Janashakthi Group, if we went as JG, there will be again that confusion with insurance.
Right.
We wanted to differentiate it. We also, in our market studies, we felt that many companies that used abbreviations successfully had 3 letters, such as BAT, which goes as BAT, or perhaps JKH or
BCG, which you just mentioned.
Some use it as a name, some use it as 3 letters, and after some discussion with focus groups, etc., we settled on JXG. We also understand that can be leveraged by marketing to talk about the exciting future we have, the exponential growth that we talk about as a group, because we are always pushing for growth. We're talking about being exceptional in what we do, and generally an extraordinary company. And that's a sort of marketing tilt. But that we have to walk the talk, so we have to get there. And we had planned as part of that launch a major town hall meeting at BMICH unfortunately, due to the protests and such things, we felt that's not the time. And that it's not just that we could not have gone ahead, we could have gone ahead, but we have to be sensitive to the mood. So what are my challenges rather than just managing the portfolio? One, my primary role is managing treasury. Source of funds, use of funds. You'll say that is also part of portfolio management. Then there's the shared services. So we had about 80 to 90 staff coming into the parent and now being deployed as shared services across the board to the other business units. So each of those heads, and we've gone into the group heads for marketing, I mentioned IT, we have a group head of legal, we have a group head of HR. And those are exciting times for each of them because they're seeing a much broader role and being able to take some of their learnings from each business unit and implement what works. So we've had, and I don't mean cost savings. Cost savings is a result of. So we've had on data storage, we've had on disaster recovery, we've had on CRM, customer relationship management, being able to take software which is used here successfully and carry it across the group. That's where the synergies really come, and that's where I feel that I lead that team. And that's the exciting part of my day.
Right. So I'm going to give you an ability here to snap your fingers and sort one problem, sort one challenge that is for the group as a leader. What would that one thing that you can't so easily solve, and if you could snap your fingers and solve that, you would?
Get a few billion rupees.
At the right price.
Yes, of course. But see, cash is king, and that is something that is very true. People use phrases like buy when there's blood on the streets. There's blood on the streets, and if you don't have the cash, what do you buy? So that is absolutely important. I also strongly believe in asset liability mix, where you manage your asset and the maturity of the asset against your liability.
Sure.
And that's important. So give me some cash.
Couple billion in cash, right? It gives me the sense that you see an opportunity for growth greatest in the financial services sector, in NBFIs in particular, where you've already done an acquisition. Is that so?
I would actually say financial services in particular, without just focusing on NBFI, because I believe that financial services is the very backbone of economic growth of any country. And accidentally or otherwise, we ended up getting into that and being in that field. Life insurance is growing. We're still very, very low in terms of our regional peers. Then we have today, we're seeing people who never heard of treasury bonds calling and wanting to invest in treasury bonds and bills. That has been good. I believe that Sri Lanka was lagging and is lagging way behind its regional partners in terms of financial literacy, evidenced by the number of people who really invest in the stock market as a percentage of population, etc. That has to grow, it has to change. That's happening now. There's entrepreneurship being taught in schools, all of those things. There's programs being done by the stock exchange. And I have my whole personal view on the stock exchange itself, because I feel that can go out further. They have not done enough. And their very name, Colombo Stock Exchange, means that they're Colombo, right? So there's a lot, but that will come. And that's outside of our control. But if we are well poised to take advantage of that, any country, financial services is big, and we're in everything other than retail banking. And I think that's going to be good for us. We're also looking at going into the region with some of these this bouquet of services that we have. And I think as a company in our 10-year horizon, we will be seeing a lot of that.
Take one more wish here, and if you could expect, or if you want something out of Sri Lanka's leaders that serve businesses like you, that employ thousands of people, potentially create a lot of jobs, wealth, and sort of secure the future of this country. And if you could ask for one thing from our leaders, what would that be?
So many people would like to ask for this utopian, free of corruption environment.
Sure.
India is also corrupt. But there's one major difference. India has consistency of policy. We do not. You cannot trust the government to implement what they will say they will implement this year, because next year somebody else will come and do a U-turn. And nobody, forget us who are stuck here, no foreigner likes that. When they come and make investments, FDIs and such things, they want 5, 10, 15-year continuity. It doesn't matter what it is, as long as it's going to be in that direction. You can't have a roller coaster ride. You can't have U-turns. You can't have successive governments dishonoring commitments. Just take the question of taxation, especially with some of the recent happenings. And I do understand the country needs tax. So it's not comments made opposing taxation. But you have retrospective taxation, never a good thing. Then you have withholding tax is a final tax, and people go and invest into debentures because withholding tax is tax favorable. Then they reverse it and say, no, it's no withholding tax, it will be taxed with income tax. Then you exit this instrument because it's no longer tax efficient. Then they say, back again, it's with withholding tax. And then it's with withholding tax and with income tax. Where is the consistency? We've seen this in 3 years. An inconsistency of every government policy is the problem of any business, and certainly international business. They don't really care who is in power. They want some consistency of policy. Only then can you plan. Otherwise, you're making short-term bets, and that doesn't work.
Ramesh Schaffter, always a sharp guy to talk to. Anything you think you need to add?
No, I think I had started on my pet subject of government policy, and then of course there's a whole review of some of these archaic laws we have. You can't cut a coconut tree, you can't cut a jack tree because we had a food shortage in World War I, and therefore you reduce any encumbrance on property, on land, reduces the value of that asset. And we have, without actually reviewing it, and even in the social life, a woman can't go to a bar and order a drink and whatever. Nobody is looking at these and saying, why don't we throw these out? Or what was the logic, and does that logic still exist? And I think we can do a lot on that.
Ramesh, great chat. Thank you so much for joining Echelon.
Thank you, Shavindra. Joy to be here.